happening, everybody? It's your boy Sean McLaughlin at Options Sean on the old Twitter X. This is the options trade of the week. Usually my man JC is with me, but JC is traveling this week. He's in Chicago giving a presentation, meeting with a whole bunch of market enthusiasts there in Chicago, my old stomping ground. So I'm flying solo today, but that's okay. Straz and I and JC all put our heads together this morning during our Wednesday morning analyst meeting. And we were kicking around some ideas of trades we want to get into. I'll tell you, the guys, especially Straza, but even JC a little bit, the guys are starting to get a little bit bullish. Straza more so than anybody. Straza really wants to start taking some long shots. He's of the mind that the stock market's going to make new all-time highs before the end of the year. I'm not so sure I agree, not yet. However, I am warming up to the idea of putting on some more bullish trades. So, Gene, if you'll pull up the my chart here of Adobe. Adobe is the vehicle that we talked about today as a stock that we want to get long. The nice thing about Adobe is we're heading into earnings season, but Adobe has already released earnings just recently, about a month ago. So Adobe doesn't have an earnings headwind ahead of it, like many of the other stocks whose charts that we like right now. So Adobe's a software name. It's in the tech sector, right? It's in the right sector that if the stock market's going to rally from here, if it's really going to rip from here, this is a sector that's likely going to lead the way, and Adobe is one of those stocks that will probably be one of the leaders. In fact, the guys think that if Adobe gets running, if the market cooperates, we can make a run back at the all-time highs for Adobe at 700. Now, does it get there next week or next month? Probably not. That's why we're doing an options trade using June options. So that gives us about 8 months until expiration. A lot of time to play out. Now, I mentioned at the top, while the guys are getting a little bit more bullish than I am, I'm a little bit more conservative. I'm a little bit more of a wait and see, show me kind of guy. I'm waiting to see more. I don't love the chart setup here, but one thing we all did agree on is that if we want to get long this stock in June, the 25 strike, the 25 delta options is right around the 700 strike, which seems far away. And it is far away, especially in dollar terms, right? It's $1.70, or I'm sorry, $170 away. But in percentage terms, it's less bad. It's like, what, 25%? I'm doing some back of the envelope math here. 25% away. And if there's a bull market coming, if there's a big breakout coming in stocks, a 25% move in a software stock is not that outrageous of an idea. But I'm not willing to be that aggressive and bet on Adobe going to and through $700. So the idea I like is that we are going to finance this trade, buying the June 700 calls. We're going to finance it by paying or by selling a naked put to do that. Now, I know a few of you out there are already thinking, selling a naked put on a $532 stock? Wow, that's aggressive. I mean, it's not aggressive, but it's going to require a lot of margin. So I mentioned in the blog post on this trade that I put out, I said, look, this trade isn't for everyone. Okay. It's a high price stock. Therefore, even just selling one naked put, which is what I did, selling one naked put here, it's still going to require in the neighborhood of $6,500 to $7,000 of margin, depending on your broker. I've heard some brokers are charging close to 10 grand, or not charging, but requiring 10 grand of margin to hold this trade. So if that amount of margin either makes you nervous or just is too big for your account to handle, I get it. Maybe this trade isn't for you. We could talk about some ways to minimize the risk in a second. But the way we're doing it, let me head to the next slide here, is this is what the P&L graph of this trade looks like. We're selling the 460 puts in June. In our meeting, JC and I talked about the 450 puts, which is a nice even round number. It's a number we liked. But by the time I got around to putting the trade on, I needed to sell the 460 puts to have enough credit to pay for the calls, because I want this trade, when I put it on net, I want to collect a little bit of premium. I don't care about how much premium. In this case, in my case, I got 90 cents, okay, or 95 cents net credit. I'm not in this trade to only make 95 cents, of course not, but I like to have, whenever I put risk reversals on, I like to have a net credit just so that if nothing works out and all the options expire worthless, at least I walk away for the trouble, earning something for the trouble. I get to keep that initial credit that I put on. Now, some of you might not care so much. Maybe you're willing to do the trade for a debit, but for me, just my peace of mind, I like the credit. So I sold the 460 puts, and I used those proceeds to purchase the 700 calls, 700 strike calls. Like I said, all in, I got a net credit of 95 cents. I just did a one lot because it's a big margin requirement. And so basically my thinking is, as long as Adobe doesn't fall too far, and by the way, 500 is the risk management level we're keeping an eye on. It doesn't show up very cleanly in this chart, but right here, these levels corresponds with the 500 line. And so if we lose this level, then I have no interest in being in this trade anymore. I will look to exit that trade ASAP, as soon as possible. I'll pay whatever it costs to get out. It'll be a loss for sure, but should be a pretty manageable loss, all things considered, especially considering I'm doing a one lot. So if we lose 500, I'm out, no matter what. But if we don't lose 500, and let's just say the stock just kind of meanders in the 500 handle level, right? You know, somewhere between 500 and 600. Worst case scenario, like I said, these two options expire worthless and I walk away keeping the credit. But if it really runs, then we're going to get leverage in these calls. These calls are going to start increasing in value far faster than, far faster than the put value. Well, that's the wrong phrase. These calls are going to earn a lot more gains while the puts just continue to decay away and fade closer to zero. So as this trade moves our way, this position will work. Now, I have a profit target. If we do get to that 700 level, I'm going to take the whole trade off and book the profit if we get to 700. Whatever I sell those calls for will likely be a profit, because in that case, these puts will be, if not worthless, pretty close to worthless, right? If we're at 700, these puts are going to be, have probably zero bid on them. So whatever we sell these calls for will be our profit. And it might be a sizable profit. This trade, as it's structured right now, has the potential for unlimited gains. Now look, like I said, if we get to 700, I'm going to get out of the trade and book the profit. But let's say the stock trades up to 675, and then who knows, some news comes out, maybe earnings or something else, who knows, and the stock gaps through our level, right? Let's say gaps to 750. That's not an unreasonable expectation. Well, we're going to participate that whole way until we get out. So our potential gains are uncapped, although we do have a price target. Once we get to 700, we will take the trade-off. Now, I have gotten some feedback from some of you. Feedback I expected, because like I said, this trade is not for everyone due to the large margin requirement. But if you still want to participate in this trade, but you want to do it in a smaller way, with less margin requirement and less risk, or no undefined risk, what you could do is you could trade this. You could trade two vertical spreads. So instead of doing a naked put, a 460 put, right? How about selling a put spread, right? Sell the 460 put, but maybe buy the 440 put. All right, you'll get a net credit for that, and turn around and buy, instead of just a 700 call, maybe you buy the 700 call and sell the 720 call. I don't know. I haven't worked out the math. I'm just piecing this together in my head. And you could be creative, right? Maybe you do a $30 wide spread on the put, right? You sell the 460 and buy the 430, right? Or the 420, all right? And whatever credit that is, you use that credit to go buy a call spread and maybe do a smaller wide credit spread, right? Or a call spread. You buy like the 700 call and you sell the 710. All right. Again, do it for a net credit. You don't have to do it for net credit, but I like to do net credit. But if you do that, if you sell a put spread, all right, that defines your risk, that lowers the margin requirement, and then smaller accounts can participate. And I thought about doing that, and I don't hate that idea, but for me, I wanted to keep it cleaner. I'm comfortable just selling one put and seeing what plays out. But either way, if we lose 500. I'm out of this trade. All right. All right, guys, that's our options trade of the week. Sorry, JC couldn't be here with us to make it a little bit more entertaining, a little bit more banter, as we like to do, JC and I. But we'll be back next week with an all-new options trade of the week next Wednesday. Until then, I'll see you tomorrow morning on the morning show here on Stock Market TV. I'll see you then. Take care, everybody.